Welcome to our deep dive on permanent life insurance and why, for most people, it can be an expensive trap. To set the stage, we will explore how cash value often underperforms, what better alternatives exist, and the steps to consider if you already own a policy. By the end, you will have a practical framework to make a more informed decision. Let's begin by outlining our agenda. First, we will cover the harsh truth about cash value and why returns can be disappointing. Next, we will discuss why term insurance is usually sufficient for protection. And then, we will present the core strategy of buying term and investing the difference. After that, we will provide a step-by-step action plan for current policyholders. We will also highlight rare scenarios where permanent insurance may be appropriate. Finally, we will test your understanding and summarize key takeaways. To transition into the core content, it is important to understand why this topic matters now. High fees, low investment yields, and opportunity costs can quietly erode long-term wealth. Many consumers buy permanent policies thinking they are investing, when in fact they are primarily paying for insurance and fees. With that context, let's move into the harsh truth about cash value. Next, let us examine cash value. In many cases, after paying total deposits of around $9.100 over years, the policy's cash value might be only about $6.500. That means you have less than your total contributions. Meanwhile, if those same payments were directed into a low-cost index fund, the balance could have grown to over $30,000. This illustrates how fees and the cost of insurance can consume a significant portion of premiums. Life insurance is designed for protection, not investment returns. If you have no financial dependence, you likely do not need life insurance. If you do need coverage, term insurance is often the more efficient choice. With that foundation, let us quantify the opportunity cost more concretely. Moving on, here is a simplified illustration that contrasts an underperforming whole life policy with a basic index fund approach and a typical term premium. In the whole life example, $9.100 in deposits might yield only $6.500 in cash value. In contrast, investing that same stream of contributions into a low-cost index fund could lead to over $30,000 over the same period, depending on returns. Term premiums for substantial coverage, such as $500,000, can range from approximately $12 to $30 per month for healthy applicants, and the difference between term and whole life cost can be invested separately. Next, let us visualize how the smarter strategy flows from decision to action. Now let us walk through the strategy flow. First, determine whether you have financial dependence. If not, you may not need life insurance. If you do, select an appropriate term life coverage amount and duration, such as 10, 20, or 30 years, aligned with income replacement and debt obligations. Then, instead of paying the high premiums of permanent insurance, route the savings into low-cost index funds. Include regular annual reviews, make sure an emergency fund is prioritized, and never cancel existing coverage before your new policy is approved and in force. The outcome is that insurance remains pure protection, while investments are handled separately for potentially better long-term growth. Next, let us quantify the time dimension of investing the difference. Furthermore, consider the time dimension using a simple illustration. Suppose you invest a $50 monthly difference for 20 years, with an average annual return around 7% after fees. Using the standard future value of an annuity formula, you can estimate the potential outcome over 240 months. The key idea is that consistent contributions and compounding, combined with low fees, tend to produce stronger long-term growth than mixing insurance and investing inside a high-fee product. With the math in mind, let us directly compare term and permanent life insurance. Next, here is a direct comparison. Term life offers low cost and high coverage for a defined period, such as 10, 20, or 30 years. It is straightforward, and you invest the savings separately in low-cost funds. Permanent policies, by contrast, often involve much higher premiums, slow cash value growth due to fees, and opaque complexity. They are frequently marketed as investments but tend to underperform. However, there are niche use cases for very high net worth households with specific estate planning needs. Now that we have compared the two, let us move into a practical action plan for those who already have a whole life policy. Moving forward, here is a step-by-step approach. First, determine whether you truly need life insurance. If you have dependents or obligations, right-size a term policy to match your needs. Second, obtain and secure your term coverage before altering or canceling any existing policy. Third, review your current whole life contract for surrender charges, loans, and cash value. Fourth, consult about tax implications and consider whether a Section 1035 exchange to a lower cost annuity is appropriate for your situation. Fifth, if you do surrender, redirect both the freed up premiums and any recovered cash value into a diversified, low-cost investment plan. Finally, conduct annual reviews, maintain an emergency fund, and rebalance as needed.
Next, let us check your understanding with a quick quiz.
Here is a quick question. For most people with dependents, which strategy usually maximizes long-term wealth while maintaining protection? A. Buy whole life for protection and investment. B. Buy term life and invest the difference in low-cost index funds. C. Skip life insurance entirely and keep cash in a savings account. Or D. Buy permanent life insurance only after age 60. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Buying term life and investing the difference in low-cost index funds typically maintains necessary protection while allowing your investments to compound more efficiently due to lower fees and greater transparency. Now, let us examine the edge cases where permanent policies may still play a role. Additionally, there are rare edge cases where permanent policies may be useful. Very high net worth households, often with estates around $26 million or more for married couples under current laws, may integrate permanent insurance for estate liquidity, trust funding, or inheritance equalization. These situations are complex and require legal and tax expertise.
Thresholds change over time, so one must verify current regulations. For the average saver, these strategies are generally not necessary. Next, let us try a quick calculation-focused quiz. Here is the second question. If you invest $50 per month for 20 years at an average 7% annual return, which rough outcome is most reasonable? A. About $6,000. B. About $12,000. C. About $26,000 to $30,000. Or D. About $100,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Using a future value of an annuity estimate, $50 per month over 20 years at approximately 7% annual returns tends to land in the mid to high five figures, often around $26,000 to $30,000, depending on exact assumptions and timing. Now, for additional clarity, let us map out the decision space as a concept diagram. To complement the flow and timeline, this mind map presents the decision space. Start with whether you have dependents. If yes, consider term coverage amount based on income replacement and debts. Choose a duration such as 10, 20, or 30 years, and invest the premium savings separately. If you do not have dependents, you may not need life insurance. If you already hold a whole life policy, review surrender charges, outstanding loans, and current cash value, and consider taxes and potential 1035 exchanges. Never cancel a policy until a replacement is in force. With the map complete, let us consolidate the key points you should remember. Here are the central points. Life insurance is primarily for protection. Whole life frequently underperforms due to fees and product design. Buying term and investing the difference often improves long-run outcomes. Always secure new coverage before canceling existing policies. Be mindful of taxes, surrender charges, and potential 1035 exchange options. Finally, permanent policies are generally niche tools for very high net worth estate planning rather than broad solutions. To ensure clarity and caution, let us add an important disclaimer. As a final caution, this video is for educational purposes only and does not constitute financial, tax, or legal advice. All numbers are simplified and illustrative, and individual results will vary. Insurance and tax regulations change over time, so consult a licensed professional before making decisions. Never cancel any policy until new coverage is approved and in force. With that important note, let us wrap up with a brief summary. To summarize, separate your protection and investing decisions for clarity and lower costs. Use term life during your peak responsibility years and invest the savings into low-cost index funds. Before making changes, review your current policy details, including charges and taxes, and ensure replacement coverage is secured. Finally, let us close with a quick thank you and a call to action.
Thank you for watching. If you found this valuable, please like the video, share it with a friend who needs to hear it, and subscribe for more practical, evidence-based money guides. In the comments, share your experiences with life insurance and what strategies worked for you. Your insights can help others make better decisions.